We got a blowout jobs number. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a surprise report. The U.S. added a whopping 147,000 jobs last month, which was well above the estimates. Meanwhile, on Capitol Hill, a final vote could come this morning on President Trump's big, beautiful bill. And on the trade front, bargaining chips. The U.S. lifts export curbs on China for semiconductor design software. Katie, what are you watching?
A lot to keep an eye on this morning, including on Datadog. AI stocks and chip designers poised to benefit from the news. Now, that marks a shift in the U.S.'s approach to export controls. You can see various chip stocks really rising right now, and I was a little bit early, but I am excited to talk about Datadog.
Yeah, well, let's talk about it right now. Datadog will replace Juniper Networks in the S&P 500 on July 9th, that fateful day, as Hewlett-Packard closes its acquisition on Juniper. You can see, as a result, Datadog shares are rising more than 10%. Katie?
We'll dig into that, but let's get back to the story of the morning, and that is that jobs number coming in hot, blowing past forecasts. Let's break down the data with Michael McKee. He is our international economics and policy correspondent. So, Mike, 147,000. The estimate was for 106,000. Where exactly did all of this surprise strength come from?
Aha. I'm glad you asked. As BlackRock's Jeffrey Rosenberg said, it is not the headline number that we care about. It is the private sector payrolls. I'll get to that in a second. Let's just run through the numbers. 147,000, as we said. Unemployment rate falls to 4.1%. That's what everybody's trading on. Average hourly earnings come in a little weak. Jobless claims for last week do fall a little bit, and continuing claims, no change at all. So basically, kind of tells you it's a status quo labor market, except for this. What Mr. Rosenberg is pointing out is that government employment was up by 73,000 during the month, so half of what we got. And that was mostly state and local, and a lot of that in education. Private payrolls up just 74,000 during the month. The labor force fell by 130,000, which is the reason that we saw the decline in the unemployment rate. The foreign-born labor force falls for the third month in a row, 134,000 fewer people than last month. And maybe that is due to the immigration enforcement. Healthcare and social workers, your biggest job category besides the government workers, as always, up 58,000. So it is a story in two parts.
All right. Well, it looks good, certainly, to markets. Michael McKee, thanks very much for that. We welcome now our Bloomberg TV and radio audience, or we are going to welcome them in just a moment to talk to Stephen Miran, because this report really was better than any of the estimates that I saw, and certainly any on our team.
And you can see that surprise in the market reaction. Futures flying, yields flying, as well as traders sort of reprice those July rate cut expectations.
Absolutely. We now welcome our Bloomberg TV and radio audience worldwide. I'm Matt Miller alongside Katie Greifeld, and joining us first on Bloomberg to discuss this jobs report and the U.S. economy, as well as the big, beautiful bill, is White House Council of Economic Advisors Chairman Stephen Miran. Stephen, great to get you on the program this morning, especially when we see such a positive jobs report, 147,000 jobs and a lower unemployment level. What is this? What is driving this?
Good morning. Thanks for having me. Look, as you said a moment ago, this report was better than 78 out of the 79 forecasts that came into the Bloomberg consensus, right, into the Bloomberg forecast. And so what we see is an economy that continues to defy expectations, continues to defy, all the doom and gloom that's out there, whether it's about the border or immigration or tariffs. This labor market continues to power ahead. And, something else that you guys mentioned, that, Mr. McKee mentioned about the foreign-born labor force, I think there were tons of predictions that there'd be a disaster in the labor market because of the border policies, and nothing could be further from the truth. The economy continues to create jobs, and if you look at the details of the jobs, all of the job gains since the president took office are due to native-born Americans, and there's actually been a decline in foreign-born workers, which means that all of the benefits of the expanding economy are accruing to Americans instead of migrants.
Stephen, I do want to talk a little bit about what this means for the Federal Reserve. We know the position of the administration is that Jerome Powell and the Federal Reserve should lower rates here, but you take a look at the numbers we got this morning, that headline blowout print, the fact that the unemployment rate is now 4.1%. What would be the case to lower interest rates here?
Well, that's a great question. I want to be clear up front that the Council of Economic Advisors does not tell the Fed what to do on interest rates. But nevertheless, I talk about the economy. And, to me, it looks like an economy that's normalizing. This is a normalized pace of job creation, a normalized labor market. And the inflation rate has been running at a 1.5% rate since, the headline CPI has been running at a 1.5% rate since the president took office. So that's an economy that's normalized and is sort of maybe even running a little bit below where the Fed would normally think about inflation ideally settling. And so I think it's only a matter of time until interest rates normalize as well. Now, I want to be clear, I'm not telling the Fed what to do, but, I would just make that as a prediction.
Well, but we still have 3% inflation, right? Average hourly earnings were up 3.7%. And the president has asked the Fed not just to cut rates, but to cut them by 3 full basis points. In what world is that a good idea?
Well, it's an idea. It's a good idea in a world in which the economy is normalized and policy will eventually catch up and normalize as well. And as I said a moment ago, inflation has been running at a very subdued pace since the president took office. It's been running at 1.5%. And I also want to emphasize that the president's suite of supply side policies through providing tax incentives for investing and building out the capital stock, deregulation, cutting red tape so that businesses can produce more with the same amount of resources, energy abundance, bringing gas prices down to the lowest price at the pump since 2021. These are all profoundly disinflationary. When you push out supply, you get lower price pressures. And so it makes complete sense to expect inflation to continue to normalize, to continue to run at a reasonable pace. Because if this is the opposite of what the previous administration did, where they stimulated demand into a rigid supply side. Instead, we're expanding the supply side, and that's going to reduce price pressures.
But I just want to follow up here, Stephen, because you got your PhD at Harvard under Marty Feldstein, which is a very good school. Can you imagine if the Fed cut 3 full percentage points? I mean, that either causes an overheating in the economy or chaos in the bond market.
Well, I think it depends. It depends where neutral rates are and how restrictive policy is. And as I said before, there's accumulating evidence that the economy is normalized. So, I think it's only a matter of time until interest rates follow. And as I also said, I think that, it's important to think of inflation as being not purely a monetary phenomenon. That's a bit of a fallacy. Fiscal policy plays an enormous role. And if fiscal policy, if government regulatory policy can push out supply, that brings downward pressure on prices. If you don't have enough goods and services and you make it easier to produce more goods and services, you get more goods and services and therefore lower price pressures. It's basic economics, supply and demand. And if you push out supply, there's less price pressure.
Stephen, I do want to get back to the details of this jobs report, but before we do, it seems like what you're arguing is basically that the Federal Reserve, and not that you're telling them what to do, but it seems like your argument is that they should normalize interest rates, get back to neutral, which does seem different than what we're hearing from the president himself, that they should not just ease policy, but ease it very aggressively.
Yeah, I mean, look, I think that there's a strong argument for the things that I just mentioned about policy normalization. And I think there's also a strong argument that the Fed has had a mixed track record in recent times of properly understanding the effects of fiscal policy. I mean, the president was right in 2021 when he said that fiscal policy was on a disastrous track and it was going to create massive inflation. And the Fed caught up to his view, which turned out to be correct, but it took them a while and arguably they were too late. And I think, again, the Fed is overly fixated on tariffs. There's zero evidence thus far that tariffs are leading to any macroeconomically significant inflation at all. You've got the Amazon, one of the Amazon CEOs coming recently and saying that inflation is not really showing up in their sales. You've got, evidence from high frequency prices in some of the research by my former grad school classmate Alberto Carvalho and others, showing that there's really only noise in terms of inflation of imported goods. And so there's just no evidence. And if you go back to 2018, 2019, same thing. We ran this experiment already. We have historical evidence. There was no material macroeconomically significant inflation. And yet the Fed is fixated on what's ultimately a small change in policy, a 10% tariff, whereas the other macroeconomic consequences of the other policies, deregulation, tax incentives for investment, these are going to be massively disinflationary, and I don't think that there's really a necessarily great understanding of the effects of fiscal policy on inflation, nor on growth. And this is why everyone gets the growth forecasts wrong over and over and over again about the effects of taxes on growth and revenue.
I'm glad you brought us there, and you did your dissertation on that, households reacting to federal tax policy. In terms of tariffs, we've been talking about this. We're all positively surprised. Companies have had huge margins, and they're able to absorb, it looks like, some of that into them so far. In terms of growth, when we cut $4.5 trillion in taxes over 10 years, but then only reduce spending by $1.2 trillion, isn't that a red flag? I mean, historically, you look at the Reagan tax cuts, we saw exploding debt and deficit from that. You look at the Bush tax cuts, we saw an extra $6 trillion in deficits after those. You look at the 2017 TCJA, we have seen another $1.8 trillion added to the deficit. I mean, can you point to a time in the U.S. history when when cutting taxes but not meeting those cuts with requisite spending cuts has resulted in the kind of growth that you're forecasting, 4 to 5% of a dynamic growth boost?
So that growth boost is over a 4-year period, and so if you divide it by 4, it's about a percent over that. It's about a percent over that period. But I think that we've got plenty of good evidence, right? So first of all, our forecasts are that we'll get in the neighborhood of 2.8%, close to 3% growth over the next 10 years as a result of the full suite of the president's policies. But that's exactly what the growth rate was in the first term until COVID. The GDP growth in the president's first term from 2017 to 2019 was 2.8% annualized over that period. And I don't think anyone thinks that we can blame COVID on the Tax Cuts and Jobs Act. But it gets better when you look through the pandemic disruptions. There was no discernible decline in revenues as a result of the Tax Cuts and Jobs Act. Revenues as a share of GDP was 17.1% before the Tax Cuts and Jobs Act, and it was 17.1% last year. Corporate revenues went from 1.6% to 1.9%. So the corporate rate was cut enormously. There were huge incentives for investment. There were, reductions in statutory and effective rates, and yet corporate revenue increased as a share of the economy. And this is exactly the type of activity that you want to see when you think that tax cuts, when you think that deregulation, when you think that energy abundance, when you think that all of these things are going to boost economic growth, and that brings in more revenue.
Well, Stephen, I hope to continue this conversation with you soon. Really appreciate your time this morning. That is White House Council of Economic Advisors Chairman Stephen Miran on that blowout jobs print that we got for June. Now let's get to Capitol Hill as the House nears a final vote on President Trump's tax bill. Bloomberg Washington correspondent Tyler Kendall joins us now with the latest. And Tyler, it's my understanding that Hakeem Jeffries is still speaking. What is the latest here?
Yeah, hey, Katie. He is still speaking. He's afforded something known as the magic minute, and that magic minute is now verging on past, at this point, actually 4 hours, as we should also say that the House has been convened for 24 hours since it was this time yesterday that they started to gavel in. And what the Democratic leader, Hakeem Jeffries, there is doing is he's essentially previewing Democrats' arguments ahead of the midterms as they try to use messaging around the one big, beautiful bill that they're going to campaign on, because at the moment it does appear that the package is poised to pass. Now, once Hakeem Jeffries is done speaking, House Speaker Mike Johnson might take the mic. It depends, since we know that Republicans want to get this finalized vote out as quickly as possible. But once he's done, we are expecting to move rather quickly to the vote on finalized passage. And the number we're going to be watching for is 217. Mike Johnson can only afford to lose 3 Republicans. And if we use a procedural vote that we saw this morning as a sort of test, it appears he is going to clear that threshold. He only lost 1 Republican vote. It wasn't a member of the House Freedom Caucus or a Republican pitching themselves as a fiscal hawk. It was actually Congressman Brian Fitzpatrick. He represents the 1st Congressional District in Pennsylvania, and he has raised concerns about what changes to Medicaid in this bill will mean for his constituents. And I'll point out, Matt and Katie, he represents a district that President Trump actually lost in 2024, which brings up this conversation looking ahead to how this is going to factor in the midterms.
We are expecting this to go through and then get to the president's desk. Do you know, Tyler, what kind of pomp and circumstance we're going to see when President Trump signs this bill?
Well, we are expecting some sort of signing, of course, on July 4th. This was always a self-imposed, but also a symbolic deadline for this administration. So I would expect some sort of a signing ceremony likely at the White House and likely with the congressional leaders flanked beside him, because we have to say President Trump had a really big push to get this bill over the finish line. We know that he was calling members directly yesterday. He invited them to the White House, and then the administration actually dispatched administration officials up to the Hill in order to get members on board. Our understanding is that they spoke a lot about the fiscal trajectory of the country, similar to the conversation you just had with Stephen Miran. We expected that they spoke a lot about this idea of stabilizing the debt to GDP ratio, talking about tariffs as a revenue raiser, things like that ultimately got those fiscal hawks on board.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall there talking to us about the legislation, $3.4 trillion tax bill expected to move through the House and to the White House soon. Coming up, chip makers are rallying after the Trump administration curbs requirements for chip software sales in China. We'll take a look at tech next. This is Open Interest.
Well, the Trump administration is lifting requirements for chip design software sales in China. This move will allow companies like Synopsys and Cadence Design Systems to resume business in the country. And as such, you can see that both stocks jumping pre-market. Joining us now with more is Bloomberg Tech co-host Ed Ludlow. And Ed, we know a lot of these chip companies have been caught firmly in the middle of these trade negotiations between the U.S. and between China. Looks like we're getting a little bit of relief this morning.
That's exactly right. The original restriction on EDA, electronic design automation software, kind of came in the tit for tat in May, where there was a concern about rare earths on the China side. It was kind of like the last remaining tool in the chip restrictions bucket. So we know that Siemens, for example, has already started doing business again in China. Cadence and Synopsys are now going to start working towards that. The software is important, right? Like the cutting edge chip of today has billions of transistors and the human brain just simply cannot design it. So the context you need to know is that there is some concern that allowing the Chinese access to these software platforms gives them some kind of ability to claw back the ground that they've lost in America pulling ahead in chip design. But in reality, this was kind of more of a political bargaining chip, both in London and the Geneva talks that took place in prior months.
What about the big question, Ed, of Nvidia selling their highest tech chips into the Chinese market? Are we going to see that barrier lifted?
So I think the latest thinking from the administration, and again, this is based on my conversation with sources, David Sachs came on the show the other day, is that the export controls as they stand now are going to work, right? The backdoor concern was that allowing the Gulf states, in particular the United Arab Emirates and Saudi, access to lead-edge chips might be some kind of backdoor access for China. But as it stands, that there isn't sort of any evidence that that's the case necessarily. We haven't replaced the diffusion rule. And there isn't any sort of codified plan of action as it stands yet, specifically to restrict in a new way, new rules, new parameters for China. And whether Nvidia in particular, because they have a monopoly in this market for AI accelerators, comes up with some kind of new chip for China, we do not know yet. There are rumblings that they're working on it.
All right, Ed, I know you'll be all over this at 11 a.m. You can catch him there. That is Bloomberg Tech co-host Ed Ludlow. Let's take a look at some other movers on our radar this morning. I'm keeping a close eye on Datadog, which is replacing Juniper in the S&P 500. Juniper is being acquired. That's also to the disappointment of Robinhood investors. There had been some speculation that perhaps Robinhood would be added to the S&P 500. The stock has been on an absolute tear. That was a factor there. Now you can see a little bit of disappointment. And Datadog just cheering the way, up almost 10% pre-market.
Datadog has been Robinhood has been absolutely ripping it, and Datadog is doing well today. We're also watching Olo, which will be acquired by Thoma Bravo for $2 billion in cash, and as a result, this, which is kind of a smaller stock is up, and now it's a bigger stock.
Yeah, $1.5 billion market cap as of yesterday's close. Apparently, it provides software solutions.
Solutions.
Yes.
That's what we all need.
So important. Coming up, JPMorgan's Gabriela Santos walks us through the jobs report reaction and her earnings outlook as tariffs loom large. That conversation up next. This is Open Interest. Welcome back to Open Interest. We're keeping a close eye on futures ahead of the opening bell after that blowout jobs print. You can see the S&P 500 extending its record run right now, up about 0.3%. The bond market is where a lot of the action is. 2-year Treasury yields higher by about 9 basis points as traders really scrap those July rate cut bets. Let's break down the reaction with JPMorgan Chief Market Strategist for the Americas, Gabriela Santos. Great to see you in person.
Good to see you.
So we're running into the break, but just give us your reaction to the print this morning, because looking at the market, seems like everyone was surprised.
I think it was good. I think it was better than feared. We had been hearing that whispers were that we would get a sub 100,000 print. If you look at the 2-year yields, they had already moved lower by 30 basis points since early June. And we had added that extra possibility of a rate cut in July for about between 2 or 3 cuts this year. So we're unwinding some of that with an upside surprise. But I don't think we should get too excited either. It still confirms this trend of a cooling but not cool labor market, especially if you take out the jobs that were added by state and local. You just look at the private jobs, 75,000, it's fine. And especially very heavily.
It's still half of the average I just looked at the average of the last 4 years, and clearly that includes post-COVID recovery, but it's 314,000, so it's not that.
Right, and especially by industry, it was very concentrated in healthcare and social assistance. That's where you still have pent-up demand. The other industries, you didn't see job losses. It's just that still that message of slow to hire.
Nonetheless, we continue to see new records on the S&P 500. We're going to talk with Gabriela Santos about that. She stays with us through the open as futures point to another record finish. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are pointing to yet another record on the S&P 500, 62.93, 62.94 on the futures there. NASDAQ up even more, 0.4%. And so we're going to see a higher cash trade as well after we start to trade. You hear the opening bell, and on the New York Stock Exchange, this is so cool. I didn't even think about the fact that next year is the 250th anniversary of America. And so, Sailforth 250 has come to preview that anniversary at the New York Stock Exchange. You can see a ton of U.S. Navy and Coast Guard members there on the floor of the NYSE. Down at the NASDAQ, Arrive AI ringing the opening bell. I'm guessing they're a software services solutions provider. The stock is down 20% since they went public a couple of months ago. So, Katie, what are you watching? More like gains.
I am looking at the chip stocks this morning. Of course, we got the news that the U.S. is lifting export curves for chip design, and you can see that in China specifically, and you can see that reflected in the shares right now. We threw Nvidia up there, but you can see the bigger beneficiaries are Synopsys, Cadence Design, both of those stocks up 4%, 5.2%. As we were discussing with Ed Ludlow, Matt, we know that these stocks have been really in the crosshairs of the trade talks. And a little bit of relief this morning. Yeah, a little bit of relief there. And we're also seeing, I think, a lot more certainty. And we're going to get to that in just a moment with Gabriela Santos. Datadog will replace Juniper Networks in the S&P 500 on that fateful day, July 9th, as Hewlett-Packard closes its acquisition of Juniper. As a result, the dog gets a boost of 10%. As Katie mentioned, Robinhood did not get that, but that stock is still absolutely soaring. We're back with JPMorgan Chief Market Strategist for the Americas, Gabriela Santos. And it's the certainty, I think, Gabriela, that makes this market happy, right? As we get the passage of the big, beautiful bill and see what's inside it, as we get closer to that July 9th date and start to get deal announcements from President Trump, can this market continue to power higher?
I really think the market has really taken its cues from being past peak uncertainty. We generally understand the contours of tariff, immigration, and fiscal policy. And now it's back to focusing on the stock-by-stock impact of policy. So policy going from an acute to a chronic issue for markets. And most importantly, moving on to what we were focused on before. So the long-term themes, AI being one of them, higher defense spending, deregulation, benefiting the financial sector. So it's really back to business as usual. It's still a resilient market, but not an unchanged market beneath the surface.
Yeah, it's interesting to hear you say that, these sort of long-term policy issues, very idiosyncratic. We were talking about the insurers yesterday, for example. It feels like
Centene.
Centene, never forget it. It feels like renewables are just a hot potato. And given those sorts of headwinds that you're encountering on a stock-by-stock, industry-by-industry basis, where do you have high conviction right now? Where is insulated from that type of noise?
So it's hard to say it's a country overall or a sector overall. But I think some themes we can tease out. It's large cap over small cap. So you still have pretty soggy economic growth. You still have elevated rates. And you still have input costs going up through tariffs. That's still an environment where we feel a lot more comfortable with large caps leading and small caps still underperforming, like it has been the case this year and for a few years. Besides that, I think leaning into areas of the market where there are other supportive tailwinds to really propel revenue growth, earnings growth. And I think this is where the AI theme really comes back. And really the new winners from AI, right? Let's abandon that holistic Mag 7 concept. Let's think about who are the new winners, the adopters who are monetizing it, and the digital and physical infrastructure winners. I also think we can look to other regions where valuations are already pretty discounted and where things are getting incrementally less bad. So that really leads us to Europe, to Japan, to India as another example. So those are areas where I think policy is a bit less top of mind.
I want to marinate on small caps for a little bit, because not that I'm pushing a narrative, but when we started this show about a year ago, I really bought into a lot of the bullish cases we were hearing on small caps. You have this valuation disconnect. These companies are more domestically focused than maybe some of those large caps. Just felt like the stars were aligning for the little guys. Turns out it was another false dawn. Why can't these small companies get off the ground?
I think if you think about when small caps work, it's when economic growth is re-accelerating, which we never expected for this year, so we were not on the small cap train. You need slightly lower rates because they're very financed by bank loans, floating rate, also not the case, and modest rate cuts is what we expect. And then you also need a high amount of risk appetite, since a very high share of these companies are unprofitable.
Got to be brave.
So it's not quite there at the moment, despite the valuation signal having been there for a while. A way we think about investing then in smaller companies with high growth potential is much more in private markets. So looking at VC, private equity, private credit, and companies are staying private for longer. So that's really more and more the market to look for that opportunity.
Gabriela, I keep going back to the IN page, the Bloomberg index browser on the terminal, which is exceptionally boring, right? I mean, if we show a picture of it, you'll see just how boring it is. But the year-to-date return column is amazing, right, for fixed income. And you've called the first half, I think, revenge of diversification, right? Does this trade have legs? Do we continue to see this as a good buy?
Yeah, if the movie of the first half of the year came out, it would be called The Revenge of Diversification.
Yes.
Especially in the first quarter, if you looked at the scoreboard, only core fixed income was positive. Because then it was much more a risk aversion, concerns about recession risk rising. So bonds really showing why they're there in the first place.
But high yield.
High yield, really there because of really the carry, right? The super attractive all-in yield of over 7%. We still think that's interesting as we settle into higher rates and lower spreads. And then also diversification by style and region.
Yeah, EM has been crushing it.
EM, developed ex-US, and not all driven by the currency, although that's been a huge story, currency diversification with the dollar down 11%, but also some incremental, less bad, you could even call it positive changes in a place like Europe. So I think really some of the things we were questioning the last 3 years, especially around diversification, they really came back to the forefront. We still think there's plenty of scope to rebalance in a lot of global portfolios.
You know, it's funny to hear you say that, talking about diversification when it comes to region as well. We were talking to Rick Reeder on Monday. He said that he owns more European debt than he ever has before. Part of that comes back to the currency, but definitely people are taking a look.
Right. And I mean, to be fair, you've been saying this for a long time. What about the dollar, though, Gabby? I mean, does that continue? We've seen a 10% drop from the high, and it's been a pretty sharp drop over the past few months. But if you back out and look at, a 25-year picture of the dollar, we're still in a relatively strong place.
That's why I think this is still a drop in the bucket of this rebalancing in currencies and global equity markets because things had gotten so stretched in the direction of the U.S. So this is where I'm not a buyer of the end of U.S. exceptionalism. I think it's just a normalization of U.S. exceptionalism after a very abnormal time period. And if the dollar is a great place to look.
Here's a 30-year chart, by the way, so you can see, my point.
Yeah, exactly. It's been 15 years of solid dollar appreciation. It's a drop in the bucket so far, what we've seen this year, a lot more room to go. And if you stretch it back even further, you would see that these things come in cycles. Before the financial crisis, we had nearly a 10-year period of dollar weakness. Dollar was still the reserve currency. It was just getting less expensive or more in line with fundamentals.
Oh, you ask and we deliver. 40-year chart of the dollar.
There you go.
All right, Gabby, that's a good place to leave it. It's always great to see you. That is JPMorgan's Gabriela Santos. Let's get to this equity market and that fresh record that we're eyeing on the S&P 500. You can see it's coming with pretty good breadth. You have over 370 names in the S&P 500 in positive territory right now, just 120 or so in the red. You take a look at what is leading us there, and it's all the names you would like to see. Amazon, Meta, Nvidia, Microsoft, Broadcom, really pushing this market higher. Berkshire Hathaway had a rough day yesterday, but it's on the upside right now. Then you look at the downside. There are some tech names in there. I'm looking at Alphabet up there at the top, Home Depot too, but you compare that to the nearly 400 names that you have in the green, not making too much of a dent. Let's take a look at the sector level as well, because it broadly mirrors what I'm saying right now. More green than red. Consumer discretionary up at the top. A lot of that is Amazon. Industrials, tech, financials, the list goes on. You take a look down at the bottom, it's just consumer staples here, down about 0.1%. So really the net here, Matt, is that this is a very risk-on day.
Yeah, absolutely. And what an exciting day it is. Not only
early
is
close.
tomorrow, early close for sure. You can watch me and Romaine Bostick on television and radio from noon to 2. And to top it all off,
tell me,
chip makers are rallying as the Trump administration lifts export curbs for chip design software sales in China. More on that next. This is Open Interest.
Welcome back to Open Interest. Take a look at this rally right now. The S&P 500 higher by about 0.5%. The NASDAQ 100 not too far ahead of it. And the small caps really leading the charge here. The Russell 2000 up 0.6% after that blowout jobs print. We'll see if that's sustainable. It just has to stay this way until 1 p.m. today because it's an early close on this July 3rd. But let's get to our top calls. Some of the analyst action in focus this morning. And first up, FedEx getting double upgraded to a buy over at BNP Paribas. The analyst there says that the stock is oversold and expects that FedEx will continue to outperform UPS. FedEx shares up 2% or so. Next up, Morgan Stanley naming KKR as its top pick among asset managers. The firm cites improving macroeconomic conditions and says that the company's diversity is positioned to take advantage of, quote, secular tailwinds. You can see shares up about 3%. And we end with Needham dropping its bearish view on Meta and moving to the sidelines with a hold rating on the social media giant. The analyst cites strong labor productivity, but remains cautious on its margins and its free cash flow. Pressure shares up about 1.4% for Meta. That has been a hard stock to have a sell rating on that.
Let's stay, Katie, in the world of technology. I promised, and now I will deliver. Synopsys and Cadence Design Systems are rallying as the U.S. lifts export curbs for chip design software sales in China. The move allows the companies to resume services in China following a trade deal between Washington and Beijing. Joining us now is Mandeep Singh, Global Head of Tech Research for Bloomberg Intelligence. And Mandeep, these companies are indeed rallying on the news, and I suppose it's kind of an olive branch of sorts, but I'm waiting for the real news of Nvidia being allowed to sell its most powerful chips into that economy. Are we going to get that?
Probably this is a precursor. I mean, we know the administration already changed their diffusion rules. So some of that demand, I think Nvidia can ship to now outside of China. And it looks like things are going in that direction where they really want the companies here to succeed when it comes to AI and really tap into demand from everywhere, including China.
And I'm curious, I mean, with that in mind, how much does this matter for, you think about Synopsys and Cadence rallying in a big way today, but we know that trade policy is very fluid, especially when it comes to the U.S. and China. So as an analyst approaching this news, taking a look at the fundamentals of these companies, I mean, how much does this specific olive branch matter?
It matters because we know China is about 15 to 20% of Synopsys and Cadence revenue. And even in the case of Nvidia, the guide that they gave us for the next quarter had China revenue almost go to zero, but anything positive would help them deliver a bigger beat. So from that perspective, it's all good news when it comes to China and, the ability of companies to sell in that region.
Hey, I want to go deeper into AI by asking about Stargate, this partnership that President Trump announced at the White House a few months ago. Oracle has now made a deal with OpenAI, whereas the latter is going to rent an even bigger amount of computing power from the database supplier. 4.5 gigawatts. I think I'm still trying to get my head around how much is how much. What kind of power is that?
Well, so just to put it in context, overall U.S. data center power consumption is around 22 to 24 gigawatts. So we are talking about a pretty sizable, almost a 25% increment to the overall U.S. data center power consumption. But look, right now we are at a point where Anthropic just grew its revenue from $1 billion to a $4 billion run rate over a matter of 6 months. So the revenues are starting to show up for these AI companies. I mean, yesterday we were talking about Microsoft cutting headcount. So the cost savings are also starting to emerge. And that's why, there is so much excitement around this infrastructure build out. I'm sure at some point we'll have some sort of digestion, but right now it looks like everyone is excited about adding more inferencing capacity. I'm still trying to figure out how the scaling laws are going to shake out this year. But clearly, there's a lot of inferencing demand, and it's showing up in the revenues of these pure play companies.
All right, Mandeep, really appreciate your analysis there. That is Mandeep Singh of Bloomberg Intelligence, where he leads global tech research. Let's get a check on stocks right now broadly, because we're still mapping the reaction to what we saw this morning at 8:30 this morning. That big blowout jobs print for June, 147,000 jobs added, the unemployment rate dropping to 4.1%. It's hard to find too much to quabble about. You did see manufacturing, that industry, lose jobs, though. Again, shedding about 7,000 there. But you can see the reaction in markets right now. The S&P 500 up 0.5%. The real reaction is in the bond market, though. Yeah, for sure. We see yields soaring in the bond market. If you take a look at the WB page, I think there we go. The 2-year yield up 9 basis points at 38.75. The 10-year yield up 5.5 at 43.31. I wouldn't quabble on the jobs number. What verb would you use? I may quibble with it. Quibble, quabble. But what I would say is,
while it's a 50% higher number than the whisper number than the survey, and while no one on our team guessed higher than I think 105, right? Joe was the winner with a guess of 105.
I did say once I saw everyone come in sub 100K that maybe it's going to be 145,000, but I was still off. The thing is, coming into this report, there was about a 25% chance that the Fed would cut rates in July. And you saw this massive plunge in the odds when we got the number, because July, we know that Jerome Powell said that he needed more data. He wanted to see this month's data. He has it now, and it's hard to build the case for a rate cut when you take a look at just how robust this labor market was.
Right. The point I was going to make is that we're still not even half of the average over the last 4 years.
Yeah.
And it's a little bit unfair because that includes, of course, just the rebound from COVID and not the drop. But that's 314,000 jobs over the last 4 years on average per month. So this isn't fantastic. It's just better than expected, which is what markets care about.
It's about the direction of travel. I hear what you're saying. Before I tease, which I am going to do, I will say we were talking with Mike McKee about how you should never trade ADP. This was another example, that ADP print, the line to NFP, it's fuzzy or non-existent.
It's a mantra I will not forget.
Never trade ADP. Coming up, Tripadvisor jumps as activist investor Starboard builds a 9% stake in the travel site. We'll bring you the details next. This is Open Interest. Welcome back to Open Interest. We're keeping a close eye on shares of Tripadvisor. The stock on the rise as activist investor Starboard builds a 9% stake in the travel site. Bloomberg Deals reporter Crystal C joins us now for more. And it kind of makes sense that you would see such a pop when you consider how Tripadvisor has performed in the stock market over the past couple of years.
Yeah, it's down about 10% in the past 12 months. And today, this pop came from Starboard taking a significant stake. And this company, it has the background as a review site, and it's really trying to transition into a booking site, trying to get that revenue that Airbnb, like Booking.com or Expedia has, but so far it's lacking its peer. We don't know exactly what Starboard's thesis is, but it's definitely saying that it's undervalued.
But there are other booking sites like Airbnb, Booking.com.
Stiff competition.
Isn't that a crowded field?
It is a crowded field. Also, if you remember, Tripadvisor actually got spun out of Expedia in 2011. So it used to be a more consolidated space, and now it's gotten a little bit more crowded. What is also interesting is all of these companies are trying to get into the experience space at the same time. So Airbnb has launched their experiences or like themed houses, the same way that Tripadvisor has its own arms doing a similar business. And those actually are some of the biggest growth driver in the company.
Right.
So we're kind of probably just seeing that this transition of travel is becoming more experiential. The younger people are looking for new experiences versus sitting on a beach and going to a nice branded hotel.
I don't know, that sounds kind of nice. But Crystal, we only have about 30 seconds left. We don't know necessarily the details of what Starboard is planning to do, but what is their typical playbook when it comes to these activist situations?
How I look at it is that this is Starboard going back to its core. So it has gone after a really, really large cap like the Pfizer, like the Becton Dickinson of the world. And what Starboard has traditionally been really good at is like the smaller cap consumer facing companies, like what they did at Papa John's, where Jeff Smith at Starboard became the chairman. So we could well see something like this.
I've been using HipCamp.
Have you?
You know what that is?
No.
Crystal?
No, what's that?
So you use it like Airbnb, but it's for camping sites.
Oh, you have been camping a
So
lot.
if you want to go camping, I've been bringing my daughters camping.
It's intense.
It is intense.
Yeah.
Good one.
Thank you.
Crystal C. From the Deals team, thanks very much for covering this story. Coming up in the next hour, Julia Coronado on that surprise jobs beat and the changes that we've seen to the tax bill overnight. Plus, we're going to talk to Stu Leonard Jr. on food costs ahead of this 4th of July weekend and the CEO of State Street Investment Management. We are 30 minutes into the trading day and looking at pretty big gains from an already high level on the stock market.
Pretty incredible. More than 0.5%, almost 0.6% higher on the S&P 500, despite that spike in yields you're seeing across the curve. As we also wait for more economic data, it's interesting. You're looking at ISM services hitting the wire right now, Matt, and you have PMI rising to 50.8 from 49.9. The estimate was 50.6, so better than expected. More strong economic data. You see that 2-year yield still hanging out almost 9-10 basis points higher on the day.
Yes. I'm Matt Miller.
I'm
You're Sonali
Basak.
Good morning. More better than expected news on the economy. And I think even more interesting than the stock market records, which we've been seeing anyway, is the rise in yields and the cut in expectations for Fed easing, right?
And just how much the stock market is shrugging it right off.
Yeah, absolutely. Let's get to that jobs report that I hope you didn't miss. But if you did, a 50% beat, basically, on the consensus. We saw 147,000 jobs added last month. I think the consensus was for 105. The whisper number last I checked was for 96. Last hour, we spoke with the White House Council of Economic Advisors Chairman Stephen Miran.
What we see is an economy that continues to defy expectations, continues to defy, all the doom and gloom that's out there, whether it's about the border or immigration or tariffs. This labor market continues to power ahead. There were tons of predictions that there'd be a disaster in the labor market because of the border policies, and nothing could be further from the truth. The economy continues to create jobs, and if you look at the details of the jobs, all of the job gains since the president took office are due to native-born Americans, and there's actually been a decline in foreign-born workers, which means that all of the benefits of the expanding economy are accruing to Americans instead of migrants.
And we are now going to bring in Julia Coronado, president and founder of Macropolicy Perspectives. A little more from that interview with Miran, with my colleagues. He had pierced the Fed for being fixated on a small change in policy, a 10% tariff, versus what he sees as disinflationary forces behind more of the administration's actions. Do you buy that line?
So I noticed that he didn't emphasize that more than half of the jobs this month came from state and local governments. So look, it's a solid job market. It's still holding on, but we do see plenty of evidence of the uncertainty plaguing private sector employers. There's just a narrowing base of hiring. We've had these big 3 sectors: private education and healthcare, leisure and hospitality, state and local governments, accounting for more than all of the hiring over the last 4 months. Is that sustainable, is the question. So, I don't dismiss this report at all. It shows that the labor market is resilient, but saying that it is super strong is definitely an overstatement. We see falling participation, wage growth is definitely cooling. Consumers' assessments of the labor market have deteriorated. So, it's a fine picture. It's resilient, I think, is the right word to use. But, I don't think it's necessarily some big growth story. Definitely it is, hiring has slowed, GDP growth has slowed. Some of that is from a reduction in labor supply. So immigrants do power jobs and create GDP, and we are seeing the evidence that that tailwind has become a headwind.
So, Julia, if you were on the board of the Federal Reserve, would you be pushing for a cut at the next meeting? I think it's July 30th, right? So, inflation has really cooled down substantially, and it doesn't look like tariffs are going to have the outsized effect we would have expected on April 3rd. Would you be pushing for the Fed to get a little bit more easy now?
Oh, absolutely not. I mean, there's no evidence that, first of all, it's way too early to conclude that we've seen the bulk of the tariff effect. These effects take a quarter to 2 quarters to show through to consumer prices. So yes, the inflation data has been benign. We've seen actually signs of the cyclical weakness in weak travel prices, weak airfares and hotel rates, reflecting weakening demand. And that's been offsetting some pressure on goods prices. But most of that effect still lies ahead, and we don't know what it'll be. We don't know whether it'll be strong or weak. We just don't know. Meanwhile, the unemployment rate's at 4.1%. You know, what is the rush to cool or to lower rates? There's, you know, resilience equals patience as far as the Fed is concerned.
You can see why there would be a patient approach at this juncture in the economy. The market is still pricing in at least 2 rate cuts this year, Julia. So if you have an administration that is saying that they don't believe the tariffs are inflationary, then what is even the administration's point in cutting rates at this point? I guess I need the circle to be squared a little bit.
Yeah, that's the great way to frame the question. If the economy is in fact fine and you're bullish, and look at the stock market, I mean, why would you be cutting rates with the stock market at the highs and the unemployment rate, you know, at your long run estimate of equilibrium? There's just no reason. If you're bullish the outlook, then we're back to the same story we were at last year, where maybe the neutral rate is higher. And if the neutral rate is higher, then there isn't necessarily a rush. Then you add in the uncertainty around inflation. Yes, inflation's been relatively benign, but let's keep in mind we've been above the Fed's 2% target for more than 4 years. So it's benign in that it hasn't surged yet on tariffs, but it certainly isn't moving towards the Fed's target in any decisive way. So yeah, why would you cut? The more bullish you are the outlook, the less the need for the Fed to lower rates.
Julia, I don't want to throw you a softball, but the Council of Economic Advisors, has forecast this big, beautiful bill to reduce national debt by $5.5 to $11 trillion over the next 10 years. And that seems wildly optimistic. Now, I grew up with Alex P. Keaton and, you know, the Laffer curve. I was, even a teenager, so happy to see the Reagan tax cuts. If you reduce my tax burden, I will spend that money into the local economy. But has there ever been a time when we've seen massive tax reductions not met by massive spending reductions and actually get the growth and the debt reduction that that Republicans always promise us?
No. There's the softball. Here's the answer.
Well,
no,
let me rephrase that, Julie. Why don't we? Because it seems to make sense, right? If you lower taxes,
well,
I'm going to pay my contractor.
Here's why we don't see it. Because, you know, you're cutting taxes amongst people with high saving rates. Okay, so most of the tax cuts are accruing either to corporations or to high income households. They tend to save those. These are not the households that are constrained that if you cut their taxes, they will spend every penny. That is just not the case. They'll just invest more or save more. So you don't get much bang for your buck. And here's where the immigration policies also come into play. You're cutting labor force growth. Most projections are for minimal to zero to even negative labor force growth by the end of the year. How are you going to grow the economy without workers? We have an aging workforce. How do you get to GDP growth? So GDP growth, it's an accounting identity. It is labor force growth plus productivity. And yes, productivity is solid. I'm a buyer of the technology story. I think we're on a better trend than last cycle for sure. But it's not going to get you 3% growth. That's just unrealistic. So you're going to need some workforce growth to get to the kinds of numbers that they're penciling in. And their policies just speak to the opposite of that. I mean, we're accelerating those policies, not easing back. So it's really hard, just from a pure mechanical accounting standpoint, to come up with the kinds of numbers that would get you deficit reduction off of this bill.
Julia Coronado, we thank you so much for your time today on that jobs report, that stunner. And next time we have you, I have to say, we have to revisit what all this means for the midterms as well, because really, really interesting ramifications for the states. Happy Friday to you. That is Macro Perspectives. president and founder. Now let's get to Capitol Hill as the House nears a final vote on President Trump's massive tax bill. Bloomberg Washington correspondent Tyler Kendall joins us with the latest. And there you see it, I believe, Representative Hakeem Jeffries with his sweet time on that bill. Tyler, what's up next?
Yeah, hey, Sonali. So the Democratic leader, Hakeem Jeffries, has something known as the Magic Minute, and he basically lets him talk for as long as he wants. He started at 4:53 a.m. Eastern. We crunched the numbers so that he didn't have to. If he wants to break the record here, that means he would talk until 1:26 p.m. Eastern. So perhaps we could be in here for the long haul, although he could stop before then, because once he does stop speaking, we are expecting that vote on finalized passage. And at the moment, it feels like delaying the inevitable, because it does appear that House Speaker Mike Johnson was able to get enough members on board that they are poised to pass this reconciliation package. Once that vote starts, we're going to be looking for that key number, 217 votes. And according to the procedure vote that we saw this morning, it does seem like all of those holdout members, when it came to those fiscal hawks, those House Freedom Caucus members, were able to get on board with this package. And we have some new reporting this morning from Bloomberg News that, of course, President Trump was instrumental in this. He made calls. He had the members up to the White House. But then we heard from Steve Scalise telling Bloomberg on the Hill that one of the pivotal parts of this is that they have been promised that a second reconciliation package is open. That's an option for down the line. We have been watching in the recent days whether or not the White House would promise some sort of executive orders or commitments to legislation that could ultimately get these fiscal hawks concerns offset to get to their vote. The other thing quickly, Sonali and Matt, that we're watching is it appears that President Trump has also promised to make sure that there is strict enforcement of some of these priorities, including the phase out of those clean energy tax credits. It's our understanding that was a really big sticking point, and having the president's assurance helped to push this vote to the number ultimately needed.
Tyler, I have always been so fascinated by the ability of congressmen and senators to deliver these hours-long speeches, filibusters that go on for double-digit hours. How do they do it? Like, does he have multiple books from which to read? And who wants to sit there? I could barely make it through 3 hours of F1 the movie, and I love Brad Pitt. How do people sit there and watch this? He's been talking for 5 hours now.
Well, just be lucky that you're not our Washington correspondent who has been sitting here and watching it for the last 5 hours. He has these binders. Now, really, the premise of this is he's not talking to his tired colleagues, who we should say have been in session for more than 24 hours. He's trying to talk to voters. He's trying to make a point here, which is that he's outlining what Democrats' arguments are going to be going into the midterms when it comes to their criticism of this big, beautiful bill. I believe he's on his third binder. The first binder had to do with stories around Medicaid. The second had to do with the Supplemental Nutrition Assistance Program, and I believe that's still the topic that we are on at the moment. And he's basically trying to make the case when it comes to those spending cuts and how that's going to impact Americans and their coverage. And actually, Matt and Sonali, the one Republican that we did see vote against this rule was Brian Fitzpatrick. He represents a swing district, a district that actually President Trump lost in 2024. And it's our understanding that he voted against this because of his concerns when it does come to Medicaid.
All right, Tyler, thanks very much I guess for you, it's a brief respite talking to us, right? Now you have to go back and watch Hakeem Jeffries for the next 3 or 4 hours. Tyler Kendall in Washington. We're going to continue to monitor the developments on Capitol Hill for you as well, but we will do it through Tyler. So Sonali and I are not going to sit and watch and listen to all of that.
The sweet time speech. But listen, I'm actually already moving on to trade deals as well. That July 9th deadline is right around the corner, and soon the market will be focusing on that as well.
Yeah, no, absolutely. So, yeah, I feel like the market has already moved on from the big, beautiful bill. We kind of know what's in it, and we got a great jobs report. The economic data continues to pile out. July 9th is definitely the next day to watch for. And, of course, we could get some deals in between, like we got Vietnam yesterday. Let's get a look at some of the single stocks moving at this hour. We saw that Vietnam deal move Nike and others that produce in in Vietnam higher. Today, we're looking at moves in Datadog, replacing Juniper in the S&P 500. That's a bummer for Robinhood investors, although they're so rich right now that they're probably not too worried about it.
Yeah, they'll get there eventually with the rate they're running at. We're also watching Olo. We're watching other types of deals. The restaurant software provider will be acquired by Thoma Bravo for about $2 billion. Everyone's watching Thoma Bravo. You and I know this. They're the ones that are spending the big money this year. They continue to do so. Let's see if it sticks. But also another deal.
Yeah, Tripadvisor is in focus. Starboard didn't buy all of it, but that's not what they do, right? They're an activist investor. They pile in for a 9% stake and try and make changes that'll make that company, I guess, more profitable, definitely do better in the stock market. Over the last 10 years, Tripadvisor is actually down 10%.
Yeah, but today it's moving up on the news. And coming up next, we're going to talk about more hedge funds. It was a chaotic first half of the year. We're going to take a look at the hedge funds that rode the volatility, extended their gains, and therefore have that dry powder for second half of the year. That's next in the Wall Street Beat. This is Bloomberg Open Interest. And it's time now for the Wall Street Beat. The biggest hedge funds sailed smoothly through a chaotic year to start the year, even adding to their gains in June despite heightened war risk and ongoing tariff uncertainty. But of course, hedge funds do like volatility. Bloomberg's chief hedge funds correspondent, Nishant Kumar, tripping over my words today, apologies. Nish, though, looking at this list that you compile every quarter is stunning. The rat race is so real. When you look at the gains, you're seeing a few really in the double-digit territory. You're seeing some of the greatest still in single-digit returns. How confident does the industry feel right now?
You know, very confident. If you put things in context, I mean, the returns may feel like boring, but it has come during a period when you have seen S&P 500 collapse 20% and then recover quickly to touch all-time high. So there is a value to this boring and stable return in an investor's portfolio. This is exactly the role of a hedge fund in a broader portfolio, to dampen the volatility and still make enough money to make their investors happy.
When you look across the different styles, Nish, and round up from your vast experience, who's doing well this year, what are the strategies that are doing best?
So top performing strategies are, of course, equity-led, and within equities, quant equity has done well. Some of the market-neutral hedge funds have done very, very well. And also, like the credit long-short people have done reasonably well, so we are seeing some double-digit numbers in there. The only kind of hedge funds that haven't done well are the trend followers, and they are down like big double digits. And obviously, this choppy market, very sharp moves in the market hasn't helped them, so that's explainable. But the equities and AI-driven funds and market-neutral quant equity has been the story of the past 6 months.
Nishant, I've got to ask you, it's interesting, by the way, I've got to say, funny to see the quants finally back up. It's been a tough run, but now it's where a lot of people are pouring a lot of money into talent. But there are sad stories, too. There are tough stories out there. What exactly is happening with Brevan Howard? This is one of the most storied funds, particularly in macro, yet we've reported that they're facing an $850 million degree of redemptions by this August. What's going on?
Yes, absolutely. So $850 million in redemption requests by August, and they have already seen a net $1 billion flow out from two of their main hedge funds. The story here is what has been happening in the multi-strat world. Brevan Howard is trying to push its clients to sign up for longer-term share classes so that they could not pull all their money out for the next 2 years. And that's an effort to gain stable asset base. All the multi-strat hedge funds have done that, and they have achieved that. It's really necessary for any multi-strat to have that stable asset base so that they are not facing sudden withdrawal of capital. And that's the step Brevan Howard is taking right now. Of course, many investors don't like that, so they are pulling their money out. And that's why we are seeing these redemptions from Brevan Howard.
Nishant, Thank you so very much for your reporting. Looking forward to your next scoop. That is Bloomberg's Nishant Kumar. And still ahead, speaking of scoops, we have an exclusive interview coming up with Yie-Hsin. She's the CEO of State Street Investment Management. She's going to discuss the firm's global ambitions and strategy under her leadership and all the partnership deals they're striking. This is Bloomberg Open Interest.
Let's get a check on the stock market right now. The S&P 500, I'm looking at it through the move screen, which is the most dynamic way to track stocks. You can see we just climb higher and higher here all morning. 333 gainers, only 166 losers, so really positive breadth. Nvidia, as you'd expect, leading the way because we have it organized by points. Tesla on the way down, but only off by about 0.5% right now. Take a look at the... Wait, can we take a look at this? Yes. Sorry, it was flashing for a second, so I didn't know if I should walk over or hang back there. This is the sectors here on the day. Tech stocks are the biggest gainers. You do have financials and industrials at the top as well. This is how it would look if we had a year-to-date picture as well. So these are the leaders, really, although I think comm services would maybe replace techs. In terms of the losers, real estate, consumer staples, and healthcare, these are defensive stocks. So when they're losing, that's really bullish. These markets, bullish. Bullish. Bullish.
That is Matt teasing my show, of course, Bullish. Of course, you can find it on Bloomberg.com. But coming up next, we're going to talk more about how exuberant people really are. We are looking at S&P 500 on its second week of gains, but do consumers feel the same way? We're going to talk about price fluctuations heading into the 4th of July weekend with Stu Leonard Jr., the CEO of Stu Leonard's. This is Bloomberg Open Interest. Now, Americans can expect to pay about the same this year for their 4th of July barbecues. According to Stu Leonard's, the price of hamburgers, buns, cheese, and hot dogs are about the same. You could find some savings when you're buying your organic strawberries. I know I'm going to be making a strawberry shortcake over the weekend, but there are still some things that you can expect to pay more for. That includes potato chips, fresh guacamole. Of course, avocado prices are something people have a lot of eyes on. You'll also still be paying generally more for eggs. Egg prices have come down quite meaningfully, but they're still up 31% over the past year. It's a sticking point for many Americans, including my colleague Matt Miller. Matt, I need eggs for that shortcake. You need eggs for the deviled eggs. You need eggs for the morning after, potentially, too. Tell us about what's cooking over there.
You know what? I actually feel like I've seen some relief. So to be clear, I only buy pasture-raised eggs. When I was a kid, I watched the art house film Baraka, and it scarred me for life in terms of the big factory farms. So I was paying $10 for a dozen of those at the end of last year, beginning of this year, and they're down, I know at Stu Leonard's, to about $6.99. Let's bring in Stu Leonard Jr. right now. He's the CEO of the Connecticut-based supermarket that makes my daughter so happy to visit every week. I have one in Yonkers. Sonali has one out in Paramus. Stu, how are you guys preparing for the 4th of July holiday?
Well, first of all, the whole family's on deck right now, okay? This is a busy, busy weekend. It sort of calms down a little bit the rest of July and August. A lot of people go on vacation. But, you know, it's busy, busy. And we notice the consumers, the customers in here, we'll have 100,000 of them this week in all our stores. They feel pretty good. They're buying, you know, and so we feel, people feel good about going into this holiday right now.
Do you worry about the rest of the year, Stu? You see the numbers, for example, for the broader economy. On a day like today, jobs are doing really well. A lot of that is government employment as well. At what point does it change, and how do you worry about that from your seat?
Well, I think, and you're seeing this in the overall stock markets and everything, there's a lot of uncertainty out there. I'm talking to other retailers, I'm talking to our suppliers, and nobody's really sure what's going to happen. I mean, there's a potential of on July 9th of a 30% tariff going into effect for Europe. So what's that going to do to all our wine and champagne and scotch and beers that we get from Europe? Olive oil, cheeses, what does that mean? So we don't know right now. There's a lot of uncertainty. Right now, if you sort of just lick my finger and I took a test here in the store, I would say people feel pretty good about the economy right now.
What do you see about the choices they're making, Stu? My wife is from Spain. She will never buy olive oil from anywhere else. I, on the other hand, have made the switch from German beer to the cannabis-infused beverages that you have there at Stu Leonard's. What kind of choices are people making?
Well, what you mentioned is a good one. Those infused sparkling waters with THC right now, rocking and rolling, really, really hot right now. You know what else is really trending is also non-alcoholic beer. That's been up right now. Now, you know what we say to our customers now? There's really 6 ways to save money or to prepare for this holiday. The first most important thing for everybody, Matt, you should remember this. I know you said you're coming to the store later. Check your propane tank, okay? The worst thing is you got your burgers or something ready to go and there's no propane. Second thing, we got a lot of specials going on this week. Matt, you mentioned eggs. If we could convert you from pasture raised, which, by the way, I think are much tastier than conventional, but these are only $2.99. So look for specials that are out there right now. The other thing we learned from COVID, you can freeze stuff, take advantage of the sales and then freeze it. Do it yourself. We have these, you can get this all cut up. We have people that have to do that. Same with guacamole. Cut the watermelon yourself. You'll save some money. And the last tip there is to walk away from our demos that we have, because we're trying to entice you to taste the product and buy it. That's one extra item in your cart. It's going to cost you a little bit more. But those are some tips for saving money. Don't freak out over the prices. They're about the same as last year, as you mentioned earlier. It's only $10 a head, basically, on average for each person. It's a lot less than a restaurant.
It's a good point to do it yourself when you come to things like the watermelon or the guacamole. And maybe part of the problem is, the avocados at Stu Leonard's have to sing. So it's not just, they don't just have to taste good, they have to be on key.
And I've got to say, I'm totally guilty for sending my significant other out to get another propane tank every holiday, Stu. I do want to ask you about something else that's happening here in New York City. As somebody who owns a major grocery store chain, you have a mayoral candidate here, Zohran Mamdani, considering a plan to establish publicly owned grocery stores. Of course, this plan is a pilot plan, and of course, he has to win the election in order for any of this to take place. But what do you think of that plan?
Well, first of all, this is a business of very thin margins. Okay, our family's been in this for 50 years of retailing. But it's not easy running a supermarket. Look, you got to run it all weekend right now. We don't get the weekend off like you would. So I think for the government to think they can run a grocery store, it's about customer service. It's about keeping everything really fresh on the shelf every day. You got to keep your prices sharp. I mean, you're in a competitive mode. We got tariffs. We got to dodge every single day. It's not easy. I was just saying, I know the Wegmans, they have a store in Manhattan. I know the Cosmetides who has Vestides. I know Abby from Morton Williams, which has a number of stores. They're struggling in New York, even with the theft issue and a lot of other things. It's tough to run supermarkets in New York City. I don't know how the government could do it.
Stu, we thank you for joining us today. Happy 4th of July to you. On this Thursday, it's not a Friday, as I had said earlier. I'm getting a little ahead of myself. Wouldn't you?
Well, it's also only the 3rd of July. So we'll wish Stu
tomorrow
a happy 4th tomorrow when we get out to his stores. Let's get a check on the markets right now. We are seeing new record highs on the stock market, so that should put a little bit of extra change in your pocket to buy those bananas. You can see S&P 500 right now up 0.7%, 6272, the level there, adding 40 points. The NASDAQ adding more than 200, almost 1 full percent to 22,852. And the 10-year yield, along with the rest of the curve, rising higher after those job numbers, Sonali, surprised to the upside.
Total blowout. But even with those higher yields, higher higher stock prices too. Some single stocks moving this hour. We're looking at home building stocks falling. You were saying real estate was the one sector down. Treasury yields advancing, so you would expect the likes of Leonard, Sunrun, Summit Therapeutics, though, is a different story, though, here, because we do have solar stocks rising on news that China will curb low-price, disorderly competition and eliminate outdated capacity. There's a lot of things moving under the hood today, Matt.
Yeah, eliminate outdated capacity means to me that they need to bring in new supply. Summit Therapeutics, you point out, is a different story. AstraZeneca is said to be discussing a partnership deal with Summit in which it could pay $15 billion to license a lung cancer drug. And the stock is down 7%.
You know, I think you've mentioned it earlier this year. Yeah, it was up a little bit earlier, but cancer drugs in particular have been a very hot play, frankly, when you look at the biotechnology stocks out there. But we're going to move on.
It's amazing because it was up 15%, and now a real swing to the downside. So definitely watch Summit Therapeutics. It does look like the shares had been halted for volatility when they resumed trading. They turned back lower, and you may get more news out of that, because if indeed AstraZeneca is going to buy or license a drug for $15 billion, you'd expect that stock to react very positively. It is itself only a $15 billion stock, so expect more news on Summit Therapeutics.
Yeah, I wonder if the market thinks $15 billion is not enough.
Or maybe the market thinks this isn't going to happen. In any case, we have a fantastic interview coming up that you organized.
Yeah, thank you. We're going to bring
in. Thank you.
Well, I'm excited to have this one for you guys. This is State Street's Investment Management CEO Yie-Hsin joining the show to discuss investment trends, her reaction to the jobs data, and the second half of 2025 and her plans. This is Bloomberg Open Interest. Now, traders are betting that the Fed will not cut rates in July, as that June jobs report blew past expectations for a second month in a row. Changes the picture of the economy a little bit for traders who are betting for less. Let's discuss this all, the state of the economy and markets, with State Street Investment Management CEO Yie-Hsin. What do you feel about the economy right now? There are a lot of people who are still in this wait-and-see mode, but the data keeps surprising. Do you think that you can kind of get ready to tell your clients to take some more money out of cash at this point and start putting into riskier equities, or do you think there's still too much uncertainty?
You know, we actually see investors moving into risk assets. You know, as one of the largest ETF providers, we're seeing enormous movement into ETFs broadly.
We have the largest ETF.
We do.
Certainly the oldest, most storied
right.
ETF in the world.
And that is hitting all-time highs today as we speak.
Yep.
But we're seeing that movement into whether it's equities in the U.S., outside the U.S., even bond ETFs. So that feeling of confidence, improved investor sentiment is coming through loud and clear. And it's been such a change from the first half of this year, where the watchword was all about uncertainty. And now we're starting to see things start to come into place, whether tariffs are going to get resolved, the one big, beautiful bill coming through to the House. All of that, I think, bodes well for businesses that have been somewhat uncertain and unwilling to invest.
You know, coming into this year, Matt and I talked to investor after investor that was saying maybe it's time to look to Europe, outside of the United States. Maybe the U.S. looks a little overvalued. Do you see that flow continuing on, or do you think foreign investors, in particular, are still ready to invest in the U.S., kind of at the expense of some of those international trades that have run up so much this year?
You know, we do see on a relative basis the U.S. economy and U.S. companies in a better position. And so we get this question from our clients all the time about this U.S. exceptionalism. It's obviously Independence Day weekend, right? Is that going to continue? And our view is it is. And then with improved sentiment, we just see the back half of the year as being a really good one for the equity markets.
What about private markets? You have obviously made a foray already into private credit with one ETF. You filed for a second ETF in collaboration with Apollo. But I haven't really seen the demand for those products. Do you see it coming? Is it just not here yet?
We do see tremendous demand. And I think with some of the changes that SEC Chair Atkins has put out in terms of creating the environment for greater convergence of private to public, that is going to continue to build as we move into the back half of this year. And for us, we're very excited about this because there's so much value in the private credit, private equity markets, and making that available to everyday investors is something that we've been all about at State Street Investment Management. And so we're excited for, this, the first of those ETFs, the second of those, and bringing that exposure to clients.
You have said in the past that you're looking to buy a private credit firm or buy a stake in one. So I'm just wondering how the search is going.
It's going well, but at the same time, we are also looking at both product innovation, which you spoke to, and areas where we can partner with other firms. Despite our size, we're nearly $5 trillion in total assets. We're really strong in what we do, whether that's index for large institutions or ETFs, and partnering with best-in-class firms like Apollo, like Bridgewater, like Blackstone.
Are you in talks with all three of those?
No, we're not in talks in terms of product co-creation, but more along those lines.
Well, yeah, Apollo, Bridgewater, it certainly has struck the attention of a lot of Wall Street, the inclination of you to step out and partner with these other managers. What does this mean for the types of products that retail investors really want to buy? Because these have tended to be high fee products that were just for really large institutional wealthy investors. Can they be, frankly, watered down a little bit to make it more attractive to the retail investor?
We're seeing interesting pockets. I mean, I talked about ETFs and making those available, but the retirement arena is a big part of our business. It represents about a quarter of our assets. And we've been first to market to launch a target date fund that has a 10% exposure to private equity, private real estate, and credit. And this sort of barbelling of index for large river categories, if you will, and then saving that risk budget in return for those components is a really good way for individual investors to gain access in a cost-efficient way.
Which, by the way, I think it's so interesting that, if you're a teacher or a police officer in a lot of states, your CalPERS or your TIAA-CREF, they're getting in on private for you. But for me or Sonali, we can't have access to those alternative investment assets in our 401ks.
That's right.
When are we going to be able to buy an asset like your ETF for our 401ks?
Well, we'll see on the ETF side, right? There's a number of applications in with the SEC for ETF share classes, mutual fund share classes, in our case, off of our ETFs. I think that will facilitate more of that exposure in retirement plans. But this target date fund that we have called Index Plus is available today. We're in market with that and have seen a lot of good interest. So hopefully not in the not too distant future.
So earlier this week, I want to ask you a little bit about stablecoins, because earlier this week I spoke to Treasury Secretary Scott Bessent about them. This idea that stablecoins in the future could potentially be much bigger buyers of U.S. Treasuries. How do you see the stablecoin universe playing out versus the money market universe, and how it might change the Treasury market?
Well, we actually think the development of stablecoin is beneficial for the Treasury market because it is backed by Treasury bills, and so the demand, we think, will actually outstrip supply. And this is one area that we've been really engaged because of those that want to be invested on-chain need a place to get yield. And so we're working very actively to tokenize our money market funds to make that available for those investors.
Now that you're seeing the Genius Act make it to the end of the line here, what are you seeing investors asking more about? Traditional way, tokenization and stablecoins, which is kind of more comfortable for a mainstream financial investor, or straight crypto? The demand for these Bitcoin ETFs have been massive.
Or tokenization of equities, right? We're seeing Robinhood do that for European investors.
Exactly, and we'll see that for private assets. I think the technology is amazing, that it can be applied in so many different areas. And we see demand across the board for all of that. And so really helping to facilitate investors' participation. For example, we partnered up with Galaxy to launch a whole series of ETFs that really takes advantage of this entire ecosystem.
Very cool.
Yeah, it's very,
It is really fascinating stuff. And I think the fact that you partner up with these, these big names like Galaxy, like Apollo, makes it even more interesting.
Matt and I both have covered crypto for about a decade, so it's finally it's taken a minute, but it's seeing its moment. Yie-Hsin of State Street Investment Management, newly branded. Thank you so very much for your time. Now, coming up next, House Republicans race to get a tax bill on President Trump's desk by tomorrow's July 4th deadline. It's still July 3rd, as Matt has pointed out to me. July 4th Eve, let's call it. We're live in Washington next with the latest on where things stand. Today, Scott Besson joining Bloomberg TV and radio at 1:30 on the close as markets close today for the holiday.
Yeah.
Starting the week with us and ending it. This is Bloomberg Open Interest.
Why did debate begin at 3:28 a.m. in the morning? Republicans are once again, which has been the case, Mr. Speaker, through every step of this journey, tried to jam this bill through the House of Representatives under cover of darkness.
House Minority Leader Hakeem Jeffries delivering an hours-long, blistering rebuttal of the tax bill Republicans are waiting to get through Congress. Leader Jeffries started his remarks just before 5 a.m. Eastern, so coming in on 6 hours now. Bloomberg's Washington correspondent Tyler Kendall joins us with the latest. And Tyler, as long as he's speaking, they can't get this through, right?
Right, exactly, Matt. He needs to finish speaking, then we could potentially hear from House Speaker Mike Johnson, and then they would proceed for that vote on final passage. And what Jeffrey's doing right now is he's essentially trying to delay the House looking poised to pass the cornerstone of President Trump's legislative agenda. And it might be worth talking about what he's talking about, which is his criticism of the changes to the benefit programs. And when we look at what this bill is actually going to do, we know that it's going to tighten the work requirements when it comes to Medicaid, as well as the supplemental nutrition assistance program. It's also going to force states to lower what's known as their Medicaid provider taxes, which would essentially mean less federal matching funds for those states that did expand coverage under the Affordable Care Act. But if you ask the administration, such as Sonali did with the Treasury Secretary earlier this week, they take issue with the word cuts, saying that they are just trying to make the Medicaid program more efficient so that the people that need it most are able to access the funds. We can also add that there was a compromise deal in this bill to try to get some of those moderate Republicans who were concerned about the changes to Medicaid on board, which included a $50 billion rural hospital fund designed to try to help out those communities that might see a little bit less federal funding come down because of this bill. We're going to have to wait and see if this delays it in a very significant way. If he wants to go for the record, Matt and Sonali, Democratic leader Hakeem Jeffries would be speaking until just short of 1:30 p.m. Eastern.
Really quickly here, how is this all going to play, knowing that Pew Research is showing that so many Americans are not actually in favor of this bill? How is this going to play in the midterms?
It's going to be a big issue in the midterms. And Sonali, the one Republican that voted against the procedural vote, known as the vote on the rule, was Brian Fitzpatrick. He's a Republican that represents the 1st congressional district in Pennsylvania, which is actually a district that President Trump lost. So it is very clear that these moderate Republicans were making their calculations as they look at this. But you should expect Republicans to really tout the tax credits, those benefits, including the temporary ones like no taxes on tips or overtime pay, as being good for voters during the midterms.
All right, Tyler Kendall there in Washington watching Hakeem Jeffries speak for almost 6 hours now. I will point out that Strom Thurmond once filibustered for over 24 hours.
There are a lot of logistical issues to staying up there that long. But I do want to let you go by promoting Treasury Secretary Scott Besson joining you, Matt, and Romaine at 1:30 p.m. today. Do not miss it in your record highs at the S&P 500.